When it comes to swing trading, there's three main strategies that you can take on. And I'm not saying take on every single one of them. I'm saying pick the one that suits you best and stick to it. So I've got my whiteboard or blackboard here. And when it comes to swing trading, we know swing trading is all about taking it from a swing to another swing. It doesn't necessarily have to be from a swing, but it's basically taking it to swing points or entering near about swing point. So what do I mean by that? Let's just say price moves up and down like this. Price moves up and down like that. When price is moving up and down like this, every single point here, every single one of these points here are swing points. This is the time the market changes direction. This is the swing. It's swung here, so on and so forth. If the market is bullish, what you're taught to do is you're taught to catch it from swing point here. You're going to try and catch it from here or from here. You might not necessarily catch it from the bottom. You might catch it from a little bit higher or a little bit higher when price is going up. Let's just say you had a few confirmations or so, and then you take it to the swing point. One thing you have to bear in mind is that there is three different kind of trading scenarios that you can play when it comes to swing trading. So the very first one is the expansion move. These larger moves up higher. That one, this one, and this one. It's when price is making a leg up or making its next move higher. When price is making moves higher, you can't be expecting large retracements like this. This large retracement will come from pulling back, when it's coming back into the range, when it's dropping back into a discounted price. So what would you do then? You look for things along this whole leg up that you could use to take price higher. You might not catch the very low of this. So what you could do then is you can catch either some kind of institutional candle, or you can jump in off of an imbalance. For example, when price expands higher, normally there's an imbalance along the way. Let's just say there's an imbalance right here. And all the imbalance is uneven trading in price when price moves too quickly. Put it that way. Price needs to be gone up and down like this, up and down. Basically, there must be buying and selling. That's what I'm trying to say. There must be buying and selling. So when price moves like this too quickly, that means there's an inefficiency here. There's only buying here. There's no sell candle that's in this range. There's no even trading in here. So when there's no even trading in here, what would tend to happen is, let's just say this is a candle. I've got two candlesticks here, and you can see price just expanded higher. So when price expands higher like this, let's just say these are three buy candles right now. What I'm referring to when it comes to inefficiency is this. Between this candlestick's high and then this one's low, so let's just run out to the right, there's been no sell candle in here. So what would often happen is price would then come back. So I'm not going to draw the candlestick, but I will just draw price coming back to offer even trading. So this would be them offering sell side to the market, and then we go long. And so this is what I'm referring to here. When price is moving quite quickly, they leave inefficiencies. And if you're able to identify imbalances, then you're able to jump in and capitalize on these moves. So for example, I'm on a daily time frame. So I'm going to show it to you for the daily time frame. On EURUSD, what do we see? We can see that price has left an inefficiency in here. We mark up that area of inefficiency. In this area here, we only offered one massive large candlestick to the downside. That's a sell candle right here. We come up to offer buy side to the market. We did it a number of times here, and then we drop. Look at this area of inefficiency in here. Area of inefficiency again, I'm going to mark it up. That kind of 6-week low, that one's high. They do not touch each other, so there's uneven trading. We run up higher into this area of inefficiency, and eventually we get going again to the downside. Let's just mark up some more. Why not? So look, there's another area of inefficiency right here. Look at this. We mark up this kind of 6-week low, this one's high. We expand it out to the right. Price comes up into this area, offers the buy side, and then we drop. Because price is dropping, it's making a large candlestick again. Check it out. We end up with another area of inefficiency. We come up into it, and then we drop. I'm showing it to you on the daily time frame, but this is how you would enter off the 1 minute time frame. On a 1 minute time frame, there's also going to be areas where price moves pretty quick. It will leave inefficiencies. And once it trades back up into that area of inefficiency, that's where you're jumping in to take the short. Now we've explained the expansion move, so jumping in based off an imbalance and taking it to a high. There's also going to be the person who wants to get involved in these retracement moves when price is moving lower like this. That's the second strategy you can apply. You could apply the retracement strategy. This is another way you can jump in on swing trading. When price gets to high and you believe it's at a point where it's going to turn around, it gives you those reversal signs, and then you jump in with a trade back into the range, and then you close off the trade. Normally what some people do is they'll bring up the Fibonacci tool, and somewhere around 50%, this is where they'll be looking to bail out. I'm not saying it's always going to go to 50%, but this is what some people do. And then they'll be patient, wait for the expansion, and then catch the retracement move again. But the difference between this one and the last one, it looks easy on the screen because it's just a line. Sometimes these retracements is not just a drop like that. Sometimes it can just be like this. Really messy, really messy. I know this is a horrible job, but it can be really messy, and you can get stopped out so many times with these retracements. And so if you're not in from a good position, then it can be a real struggle sometimes. Not only that, these moves are a lot shorter. So you can see these moves, they're roughly about double the size or triple the size, these expansion moves. when we're bullish, these bearish moves, they're a lot shorter. So you're in the trade for a shorter period of time, which might be a good thing actually. But the pip range, so let's just say if this was 100 pips, this move here might be like, let's just say 50 pips. And obviously swings are a lot more than this. Swings can be around that 100 to 200, 300 mark, even longer, just depending on how long you hold it. That's one of the differences between the two. But don't forget, like I said, it's more risky. It's more risky because it's not just easy. Some of the things that you can look at here is when price is making moves up like this, so expansion like this, it's not just going up in a straight line. It will be doing ups and downs like this. So let's just say this is the retracement now. It will seek liquidity beneath some of these lows like this, run it, and then go long. So this is what you're doing when you're jumping in on those pullback moves. When price is dropping like this, so this is just this magnified, it's actually dropping like this. It's actually dropping like this. There's money placed above every single one of these highs. All kinds of liquidity placed above every single one of these highs. And once price gets going again, let's just say it drops. Once price gets going again, this expansion move runs out all of that liquidity, takes all of that money. The reason why we're retracing is to generate liquidity to run it later. So this is why you can't be holding on these positions for far too long, because you will get played. And don't forget, price doesn't always move like this. Like I said in my last video, price sometimes will drop like this, then go sideways, and drop, and then go sideways, and then drop. It's very tricky because let's say in from here, price drops down to this level. Let's just say you have moved your stop loss, you get taken out, and then it drops again. You're frustrated. And then you're chasing the trade. It moves quickly. You jump in again. You get stopped out. All kinds of madness. So be very careful with that. When it comes to retracements, this is what we're looking at. If this is an expansion up to the upside, the retracement move would be the high to the low. Another expansion up to the upside, the high to the low, that's the retracement. We expand up to the upside. This one here from high to low. This is what I was saying about don't be so caught up with it coming back to 50%. Be more so concerned about, is there an area of interest, like an imbalance or an order block that you could use? So look at this move. Here to here, it didn't come back to 50%. It came back to the area of inefficiency and then expanded. This one came back to 50%. So let's see if I can just mark up here. It came back to beyond 50%. It came back to fill in this area of inefficiency, and then it expanded up to the upside. Always look for the area of inefficiency within that expansion up, because that's most likely where it's going to go. So next, we're going to be talking about the continuation move. And this is when price retraces, because we are bullish, when price retraces down into a discounted price before going back long. When price drops, most likely it's going to drop to near about 50% of this whole move higher. Some people like to use the Fibonacci tool for that to mark it up and know where exactly 50% is. Nothing special about it. But what I like to do is I like to take it a step further. I like to look for an area of interest within a discounted price. There could be an imbalance here that's not been traded to. There's uneven trading. And so what I would expect price to do is I expect price to drop into that area of inefficiency and then take it long. And this area here is at a discounted price. That's what makes this a lot stronger, or a stronger area for a continuation. If I was to jump in here, so somewhere about these highs, let's just say this was a bit longer, and 50% is down here, it's always going to be a riskier play. So this is why I don't necessarily promote jumping in based off areas of interest that are above a discounted price, or if we're bearish like this, areas of interest that's below a premium price. So price ran this low, came back into the range, premium is roughly about 50%. So I wait for price to get into an area of interest and then look to sell it. If this is where equilibrium is, which is 50% of this move down, premium is going to be above it. I'm not going to be jumping in off trades from beneath a premium. Most likely what could happen is price could expand high a little bit, run the low, and then go. So we've taken that liquidity beneath this low, and then we go higher. So this is why I always wait for price to drop into a discounted price when bullish, or a premium price when bearish. So the very first thing to know that you got the direction right is that price will make large moves in your direction. When price was dropping, these are the huge drops, by the way. So from this high to this low, we're talking about 262 pips. So don't be fooled by looking at the screen and thinking, oh, this is just a little small drop. No, guys, these are huge drops. So when price is dropping, it's making large candlesticks to the downside. So I'm going to go ahead and mark up all the large candlesticks that I can see. Show me where the large buy candlestick is here. There's none. There's none. There's none in here. There's none in here. Let's zoom in on out to the left. Now, that was when price is dropping. When price is going higher, let's look at what's going on. Now let's look at this. From this low to this high, that's another large candlestick. I want to say candlestick, I'm looking at the large plays. Looking here again, from here to here. So now let's look at what's happening with price currently. Where's price making the larger candlesticks? To the downside. Look at this large candlestick here. This whole candlestick, and then we've got another one right here. This is a 2-day play. Let's go ahead and mark up the 2-day play. Here to here. 74 pips, not large like that, but it's larger than these buy candles here. This one here, from here to here, 140 pips, larger than this buy candlestick right here. So what I'm trying to say then is price will make large candlesticks in your direction. That's one way you're going to know that you've chosen the right direction. Price will make large candlesticks in the way you want it to go. Look out for large candlesticks on the daily time frame. Another tip would be price is using imbalances to move even lower. I just explained this to you guys. Let's just look at this one over here. Let's look at what's happening currently with price now. So let's go ahead and mark up this. What's price doing with this drop right now? This is an imbalance. This kind of 6-week low to this one's high. If I expand it out to the right, or if I expand this out to the right now, price trades into this area of inefficiency, offers buy side to the market, and then it drops with a large play. But when it drops, what does it do? When it's dropping beneath these lows, it's leaving areas of inefficiency again. EU is going up into these areas of inefficiency or these fair value gaps, and it's using that to drop. We're seeing that price is using these inefficiencies to drop. And so when you see something like this, this is telling you that you're in the right direction. So this is why I'm telling my mentees, I need to see price trade beyond this and stay above this on a daily time frame for me to start thinking price is going the opposite way, or might want to attack some buy side liquidity. But as long as it's staying beneath it like this, that's when I stay bearish. And then when it comes to these areas of inefficiency, it does not need to close in the whole thing. It can just trade into it. It doesn't even need to wick past the whole thing. It could trade into it and then drop. In here, you'll be looking for some kind of reversal sign to take price lower. I thought I would give you one more tip, a bonus tip. I hope you guys know that you got the direction right when you're swing trading. And this one is one that I really like to see. So if you are bullish, you want to see buying at sell candles. And if you are bearish, you want to see selling at buy candles. This is a sell candle here. This is one sell down. So I'm going to mark up the very high to the very lowest point. And what you want to see is when you extend out to the right from the wicks, if you extend out to the right, when EU dropped back into this range, what happened? We saw buying. And let's go ahead and do it again. We're going to mark up from the very high to the low. We're going to extend it out to the right. Price didn't come back to it here, but if it did, you would want to see buying at here. And then you know that institutional order flow is to the upside. What that basically means is that if you jump into buys, it's most likely going to go and run out some buy side liquidity. Now let's look at the sell side. So you can see here, there's a buy candle in here. We're going to mark up where it opens and take it to the wick and extend it out to the right. When price came back up into it, what did you see? You saw selling. We're going to run it back again. Once again, this is another buy candle. Mark it up from the open to the end. And then we extend out to the right. See, we trade through this low here. We come back into it. When we come back into it, we see selling. So it's just telling us that institutional order flows to the downside. And so that means if you can catch a swing position nearabouts one of these highs in here, in one of these imbalances, you should be confident to hold it to at least the low. That's another tip you can use to know that you've got the direction right. And now just the final thing, I'm going to share a little bit about where I'm expecting my EU swings to go right now. Is I'm looking for EU swings to run beneath these lows. We've made an expansion lower, we've retraced up higher, expansion lower, we've retraced up higher, another expansion lower beneath this low. And the reason I've not just stopped here is because this one's pretty close together. This one comes in at 1.0795. This one comes in at 1.0802. So roughly about 7 pips. So I'm looking for price to run these lows. I was in from nearabouts these highs, close those trades. I'm in from nearabouts these highs, and I'm holding these trades to get down to these levels here. I've used a continuation play to take out more sell side liquidity, which is resting beneath this low and that low.